And we are back once again, Jubilee Market episode 3. So this is going to be a Q&A session. So if you're tuning in and you have questions for Mike or anyone on the team, feel free to drop them in the comments. This is live wherever you're seeing it. At least if you're seeing it on September 30th at about 4:15 Central Time, it's live. So Mike, let's go ahead and bring you guys in here. We got Mike. We got Alex. We got Tim. Tim's kind of cut off there, but we have everyone on here. Well, let's go around the horn. Start with our CEO. He's to my right, Tim Kotzman. Maybe a quick introduction for everyone if they're not familiar with who our team is.
Yeah, thanks, Ryan. Tim Kotzman, and I'm excited to talk about charts. That's it.
That's it. Short and sweet.
So let me take it. So Mike Pflaum, VP of Marketing for Jubilee Royalty. I'm also the lead investor on fund, the Jubilee Royalty Fund number 2 that we've done. And with that said, I'll be doing a recap, taking some live questions, some questions from these guys about charting, about candles, about 50 and 200-day moving averages. And I'm happy to be here, Ryan. Thanks for setting this up.
And Alex Pedraza, VP of BizDev, avid follower of Mike's in terms of his personal investments and strategies, trader of my own, primarily cryptocurrency, some stocks and options, but here to provide support and ask a couple questions.
Yeah, and so last week, recap, we had a session with Mike and myself. We'll link to that and share it on our YouTube page or on LinkedIn so you can go back and watch it. We talked about a couple of charting examples, Mike, the golden cross, the death cross, maybe a 30-second refresher for those who missed it, and then we'll get into some questions.
Yeah, thanks. So let me share my desktop, and what we'll do is I'll give a quick refresher on what I covered last week. So let me move this out of the way. So in the presentation, we have candles, and these candles, they're either green or red. It's relatively simple. The candle has a body, which is on the left is the big green one, and then on the top you have a wick, and you have a wick on the bottom, which is a little skinny line. So if the close is higher than the open, the candle is green. That means the price from when that increment opened, whether it's 15-minute, 1 hour, 2 hour, 4 hour, 1 day, that means that the price went up from the open to the close. Now, the open to the close is not necessarily the high or the low, and that's why you have these wicks. And then on the right-hand side, you see we have a red candle, and that signifies that it opened up at, let's say, $100, and it closed at $90, so it's red. And so what you're able to look at in each increment is whether the price is going up and down in that particular increment. So when you look on a chart, and I'm going to jump to the chart right here, the chart on the left that I'm showing, if you look over here in the upper left-hand corner, there's a D, and so you could pick the increment. This is a daily chart. 1 day is set, and these are daily candles. And what I was saying just 30 seconds ago was this green candle over here on September 27th. This was a great green candle. It was all body. There was no wick. Whereas the next day, this is like the best example you'll find, natural gas. Natural gas is very volatile. The next day, the body is very, very small. And if you look in the left-hand corner, it tells you what the price is here. Here's the open, the high, the low, and the close. So on that day, it opened at 586 and it closed at, it opened at $5.86 and it closed at $5.85, 1 cent lower. So the body is very, very small. It's only 1 cent, and the wicks were huge. So on that day, you're like, wow, the price shot up and came back down. The question was, is it going to trend down like you see on the 15th, where you had a big wick here and it trended down for 4 more days? How long is that going to last? And the next day on the 29th, this is a really good example. You have a big red body. And that's like, wow, it looks like the price is going to trend down for the next few days. But as we all know in the marketplace, it rocketed right back up the next day with this massive green candle with very small wicks. So what this is showing you is that the price is keeping this upward trend. And I'll take questions in a second. The white line is the 50-day moving average, and the yellow line is the 200-day moving average. You can see this in the left-hand corner, 50 and 200. So the price is way above the 50-day moving average. So it's possible it could have come down, but it didn't. So let me stop right there and take any questions about what I'm showing you guys.
Yeah, so let's kind of unpack this again. And one of the things I think was helpful from last time was what we're talking about here translates in from stocks, commodities, crypto. It's a general principle that you're talking about that can be applied to any type of charting, no matter no matter what index you're looking at, right?
That's correct. That's correct. So these candles work the same whether it's commodities or stocks. The candles work exactly the same way, and the same thing with the 50 and 200-day moving averages. This over here, this is a golden cross. This is when the 50-day cross is over going up, so it's a golden cross. This over here is a death cross where the white line goes below the yellow line. That's considered to be, a bearish signal. But you see, it didn't last that long there. Whereas after this golden cross, it continued to shoot up. So that's a good example of, here's a better example of a golden cross where it continued to go up and then it crossed over and you're like, oh, is it going to trend down? It could, but it was just going flat and then it rocketed back up again. So that's what we're talking about in the last, the main concepts we talked in the last episode.
Okay, so we have a question here from Justin. What is your preferred platform for charting?
My preferred platform is I use Thinkorswim by TD Ameritrade, and it's free. And the reason why it's my preferred charting platform is because I've had it for 10 years, and I have lots of complex charts and templates built into it. TradingView, and that, by the way, Thinkorswim is free with the TD Ameritrade account. TradingView can probably do all the same things. Maybe it can do more things. But I've only been on TradingView for about a year and a half playing with it. And so I'm not as adept with TradingView.
Okay, let's follow up on that for half a second. If I'm understanding what you're saying, it's not so much that Thinkorswim is superior, is that you've learned how to draw the lines, how to build out templates, you said, and you kind of got in there and mastered Thinkorswim. It might be the superior one, but you've really dug into how to use it and make the platform work for you. That seems to be, if you're getting into charting, it might not behoove you to go to 15 different charting platforms, but to find one and try to master that one.
Exactly. That's the better thing to do, is to master one platform and get better at it. What I can tell you what's better about Thinkorswim is not whether the charts are better, is that all the functionality is free, again, with a TD Ameritrade account. And I'll switch over and show this to you. These charts are much more complex, and I'm able to do multiple moving averages. I could do percent change over here, MACD, RSI, and unbalanced volume. These 1, 2, 3, 4, plus the moving averages. TradingView, I believe, limits you to 5 metrics at one time, unless you pay for the pro and then like the institutional one. So that's why my TradingView charts are much more simple versus my TradingView is more simple compared to Thinkorswim. But in essence, the information though is about the same.
Okay, Alex, I want to bring you in here. Yeah, I'm sure you have some questions because you are, as you mentioned, a trader yourself. So,
yeah, I've got one kind of going back to some of the major sort of trend indicators, specifically the death cross. And Mike, I'd love to know if you've got a sense, how frequently does a chart ignore a strong trend indication like a death cross? I mean, sure, there's no specific number or even percentage, but in your experience, is that something that usually is indicative of what's to come, but maybe on a shorter interval than you may think? Or how do you kind of approach that?
So you always have to look at it with a second metric. And so on TradingView, it doesn't, or I'm not as familiar with it in terms of showing volume. So what you always want to see, maybe I'll switch over here and I will pick here Apple. So if you look at Apple on this chart, and this is again, this is the 50 and 200-day moving average. And let me blow this up. The green and red lines on the bottom show volume. And what you do over here is, if you have more volume, whether it's the price going down or more volume, the price going up, that's what leads you to think that you're going to get it's going to be, it's going to boost your confidence that that trend is going to happen. Like over here, this one, the only thing that's different here is that the white line is the 100-day moving average. So with Apple, you don't really get, it doesn't really drop down. You don't really get a really good death cross in the 200-day. It rarely hits that. So over here, this blue line crossed the white line. And that's not really a death cross because it needs to cross this dotted yellow line. But if you look here, the volume is decreasing a little bit, but on you're just saying, the trend down is unlikely that it's going to continue because you're looking at it also with volume. And then the other metric you can use over here is what's called MACD, moving average convergence divergence. And all this means is that you're going to have to pick multiple indicators to determine that. So the price started dropping right here, but you can see it was still trending up on the MACD, and then it peaked and then it started going down again. So the question is that if you're looking for an entry point, if you're looking to hold something for more than a year, you're probably not going to, depending on how it trades, you may not hit that 200-day moving average or go below it. So then you would just buy it for Apple. So it's a long-winded answer, but you need to look at something else besides just the death cross and the golden cross. You need another indicator. And I like to use volume and MACD or something else.
Kind of, an extension of that, one of my other questions, it's a good segue, aside from the major ones that you touched on, and it's understood that using them in correlation is important, but what's a lesser known but still, I guess either highly important or highly efficient, effective technical indicator that that you use or that people may not know about besides moving averages, MACDs, and of course volume weighted versions of those?
Sure. So another great indicator, and this is one reason why you can see I have much more complex charting on Thinkorswim. I like this one called on balance volume, and let me blow this one up. What on balance volume does, OBV, right here on the bottom, what this is showing you, and it oscillates at the 0 mark up and down, and all on balance volume tells you if the price goes up, it adds it from one day to the next. If the price goes down, it subtracts it. So this is the 0 mark right here. And as long as on balance volume, when the price is going up, you want this to be going up. If the price is going down and you want to go down because you're selling something short, you want on balance volume to trend down. And so this is just another indicator that some people use that's a little bit different, and I'd recommend that one. And the next one also is the RSI, relative strength. This is between 70 and 30. Basically, you sell when something is, you see this over here, it's red. When it trends up, this is, again, it's a daily chart. When you're at 84, you're pretty high in the daily chart. And if you want to take some profit, that's a good idea. And then you look to buy back in when it's well under 50. It may not get below 30 because it's Apple. So you have to realize you don't want to get too greedy. But this ranges between 0 and 100%, and above 70 is considered to be overbought, and when below 30 is oversold. So that's the other indicator. So these two, RSI and on balance volume, are two other indicators that you should learn to use.
Mike, you've mentioned that, if you're new to this, it's going to take you a month or two just to kind of learn how to use these metrics and whatnot. But one other thing that you've touched on with Apple, which is a very popular stock, is, the seasonality involved. So you're kind of getting into fundamentals. How do you balance that with fundamentals versus the technicals, and trying to figure out what weight to give to which side of the equation?
Well, again, I'm going to go back over here. You should be able to see my desktop. I'm back at Apple again. You can look, when they go into quarterly, you can see here that Apple tends to run up when they go into the earnings, when they're going to announce earnings. You get a lot of volume around that. And so you have to think about it. If the Q4, and I'm talking about calendar Q4 because Apple has a different fiscal calendar. But if you know that people buy computers for back to school and they buy phones, and Apple comes out with a new phone typically every September, it tends to going to do well in the calendar fourth quarter. And you buy and hold in that. And the other thing is you don't sell your whole position. You could trade 20% of your position and keep 80% of it, or pick a number there. So that's the idea between the seasonality. Again, with same thing with natural gas. Look, we're going to natural gas is really expensive right now, but it's going to be October tomorrow. So my bet is that natural gas will continue to go up, especially if if we have a cold winter and people need two things. Natural gas is used for heating, and it's also used for electricity. And right now there's huge demands on it. So I consider natural gas to be going up because it's going into the fall, in addition to the other supply squeezes with it.
Okay, let's talk about the candles. You know, if you kind of, and this is important, you've mentioned this before about length of trades. If you get on, look at people charting, they'll start talking about the candles, like, hey, look at this candle, and then this candle, and this candle. This is like a Thor's hammer, reverse bow and arrow, and then there's a Fibonacci retracement. And like, okay, are you talking about that stuff too, or is that outside of what we're encouraging our investors to look at?
The reason why I'm smiling, because I've been watching people draw lines on charts for the past 5 years. And what I can tell you is that there are arguments over how to draw the lines on the chart. And you can go research everything you just said. In terms of the Fibonacci's, what I found out from looking at charts now for, doing this, being more advanced with charts for at least the past 5 years, is that you're going to find something that you like, and then you want to get really good at that one thing. It's not that you want to look at other things, but I happen to like the 50 and 200-day moving averages. I like the RSI. I especially like daily, weekly, and monthly charts. And I'm an investor, more of an investor than a trader. So if you're looking to try and do more advanced trading, then try those other charts. But in the end, what matters is from January 1st to December 31st, what's your return? If you're doing a lot of trading and your return is 25% overall, whatever you started with, I would bet that you're a better investor, and maybe buy and hold is the ultimate indicator. So in the end, I really don't care what chart you use, but you need to look at yourself and say at the end of the year, what was your rate of return on whatever you were trading with? And if you're a good trader, you should be higher than 50% returns per year. Otherwise, I would tell you to just straight invest. That's my number that I'm throwing out there on the internet. If you're not making a 50% yearly return in your trading, you're probably not a good trader.
I think that's fair. Mike, I've got something on a slightly different subject, and
Sure.
It's kind of a two-part question. So, we've talked about charting in linear versus charting in log scale, specifically with cryptocurrency. So I wanted you to touch on the difference, there specifically for crypto. And the second part of that question is there a difference in charting linear versus log in terms of commodities or equities as well? I'm just not, too familiar.
Okay, so let me give an example. So this is a daily chart, and I'm going to change this to a monthly chart. So each give me a second for it to rescale, because we're showing lots of years here. So this is a good example of why we'd probably want to switch. This is natural gas. This is not crypto. Okay, but I'll explain linear versus log here in a second. So this is a linear scale. And what happens is the price ranges from about $1 all the way up to over $15. That's a massive spread. So this is the same chart here, and you can see this is a really big, this is a monthly candle here for natural gas. So this is a big outlier. The month of September. This will be so it looks like we're trending higher here. And you can see the RSI is really high. But I'm going to switch this chart, this button over here, toggle to log scale. Again, it's the only thing to do is just changing the scale. Now, when I look at natural gas in log scale, while we still have this big green candle here, doesn't look as crazy as it did before. It looks more normal. And this is why you switch to log scales when there's a big spread between the low and the high price. This is $1 and $15. It's a 15x difference. So now when you look at this, it kind of looks kind of normal. And I would bet I don't trade natural gas futures, but I would bet that they use log scale for this because of the volatility in it. So hopefully that answers your question. On natural gas, I would use log scale. But if I was doing oil, let me switch this to, again, I like comparing these two because they are both commodities. Now this was kind of odd over here. This is when oil traded negative, but that was a really weird one. But I will go down here like this. See, I'm looking at this oil on, again, this is log scale, and it looks pretty normal. If I switch it to, doesn't look that much different in linear scale. So it depends because the spread here is from $20 to this 140. It's only a spread of 7x, whereas natural gas was a 15x spread. That's why the natural gas would probably work better on log scale versus oil.
I think we have one question from the boss man himself. Tim, did you have one?
Yeah, Mike, might be similar to some of the thoughts that Ryan had, but how do you think about, and does it matter which asset class it is, of balancing out what you're seeing on the charts? Ryan said it using the word fundamentals, but I'll use, FOMO, fear of missing out, versus FUD, fear, uncertainty, and doubt. How, the narrative in the marketplace and everything that you might see on CNBC or Twitter or wherever, how do you balance that out versus what you see on the charts? Are there people out there, I mean, I would assume there are people out there that they only look at charts and they don't even look at the news cycle, or people that look at the news cycle and don't even look at charts? So again, it might be similar to what Ryan was asking, but how do you think about how you would go about balancing that out using one extreme or another, or something in the middle?
Look, I think that's a great question. I think on CNBC or any of these news shows, they're going to talk about anything that's very volatile or makes a big price swing because it's interesting. I would guess is that more retail traders will jump in and out of Apple stock and will play with with Apple stock or Microsoft or any of the S&P 500 stocks versus commodities. And I'm just saying that I think that that's where they're gonna jump in and out of. I don't see as many people going specifically into natural gas versus oil. So with that said, I think that's the way the retail trader would operate. I think it's easier to get your hands on where at Microsoft, Apple, Netflix, Nvidia is going, because they're tech companies and we're in a tech world, versus some of these energy components where they just have to think about the seasonality. So that's my take on it. I think that the only exception to that one from a retail trader perspective is buying gold or GLD, the gold ETF. I think they would buy it in and out of that one or hold that one. But besides gold or silver, most of the other ones I think are fringe purchases. CNBC like to talk a lot about lumber prices. I don't know anybody, and I've never purchased lumber futures or lumber ETF, even if it exists. I don't know anybody that's ever purchased that, and I know lots of investors. So my takeaway is that while the lumber story was very interesting to talk about last year and this year, I don't see a lot of my retail friends buying that at all.
Okay, we get just a few minutes here, Mike. Let's
Sure.
get some rapid fire questions. First off, how long after an IPO before you will start charting a stock?
Okay, on an IPO, if it's something that I was following and anticipating, and you've been doing this for a few years, with an IPO, it will come out to certain brokerage houses before other brokerage houses for whatever reason. So if you are good at trading, you've done this before, you could buy on the first or second day, get in and out. Now, I could tell you that I've done that a few times and it's worked out great. I've done it a few times and it has not. So charting, there is no charting that will cover the first 5 days of any IPO. Anybody telling you that is completely wrong. Everybody's buying on the ability of emotion, of future momentum, and there is no charting that works for the first, I would say, for the first month or two on that. And so on that, you're buying solely based on momentum and how good of a trader you are.
Okay. Yep. So we're saying at least a month, 2 months, maybe in a quarter on that. The next question is, we talked about length and 50% returns. If people want to go follow traders, I'm guessing we're saying more of a swing trader is who we would advise them to go follow, right? Was that the right term?
I think, yes, swing trader would be better. Somebody that's typically going to buy and hold for at least 6 months. I prefer 1 year because then you'll get long-term capital gains. So I recommend that you hold something. And then when you sell, if you bought something that's really good, you should be holding 50 to 80% of it. And you should only be trading 10 to 50% of your total position. Otherwise, you have to think about why you actually bought that. If you're a true trader, you don't care. But I'm an investor. And so my view is I always want to be able to hold 50 or 80% of my holdings for more than a year, for multiple years.
And so the final question for me, and we'll wrap up with this, is if you want to get in and you want to use the indicators that you've used, that you've talked about, then get in and you need to use those 3 or 4 daily for months. Don't go to looking at Fibonacci's and all this other stuff. Master those in your platform. That's probably just as important as anything else, because if you can't master how to chart, then you really don't know what you're doing.
Agreed. You should master a few good charts, do your trading, and the best indicator you don't need me to tell you this, but if you do 10 trades and 8 of your trades lose money, I would tell you you better stop trading and reevaluate, do paper money trading and practice before you start losing more money. That's the indicator. If you're losing 9 out of 10 trades and one trade makes all back your money, you just got lucky. You're not a good trader.
Okay. All right. Anything else before we get out of here, gentlemen? I think that's a wrap for us on Jubilee Markets. Episode number 3. We should be back next week-ish, is the plan. If not, maybe the week after. You can find us on social media, jubileeroyalty.com. And until then, we'll be on LinkedIn talking about all kinds of stuff, charting, investing, and we hope to hear from you very soon.
Great. Thank you. Thank you, Ryan, Tim, and Alex.
Thanks, everyone.